Ladies and gentlemen, welcome back to Harvesting Income. Make your income, grow your income. That is the theme of this channel. So, today I'm going to talk about two funds which are into the gold mining or gold producers space. One of them is GLCC and the other one is the AMAX. So, before I get into this one, I just wanted to quickly show you that today, as on June 5th, we are seeing a big bloodbath in the markets. Like you see S&P 500 down by 1.8%, Nasdaq down by 3%, and similarly Russell also down by about 2.9% and so on. Highly volatile today. So it's the right time that I chose this topic, and one of the things that I was trying to see is uh, did I pick the wrong gold fund, or are there other gold funds which are doing well? So I looked at a few funds in the Canadian markets. So I have GLCC, that is the Global X Gold Covered Call ETF, and AMAX. AMAX is the similar gold covered call fund from the Hamilton funds. So they have a kind of similar strategy. Strategy of GLCC is exposure to gold mines, and they also write covered calls for income. And AMAX also follows a similar strategy. Now, the whole purpose of the video is two things. Uh, One is looking at the performance of these funds and which of these funds perform well in terms of generating income and total returns. And we are focusing on the total returns because that's the final metric that decides the success of a fund. Now, before we go ahead, this is all for educational or entertainment purpose, so not investment advice. So before making any decision on your choice of fund, do your own due diligence or take professional advice. Okay, with that disclaimer, let me quickly look at other features of the fund, and I'll go through each of them to give you a quick summary. Basically, the GLCC's covered call writing style is more active. They can decide to write lesser amount of covered calls or more, and AMAX, it is pretty flexible, but it's going to be around 50%. And for the difference is the GLCC can do up to 50%. They can do less as well. AMAX will try to maintain the 50%. So that's the key difference. Keep that in mind when we move to the next area. And I'll discuss the ones highlighted in the red box uh, at a later stage. But before that, let me give you the overview of these two funds. Because a lot of viewers are new and probably not familiar with these funds. So I'm going to give you a quick summary and also some details on the strategy of these funds. So let me just quickly move to the other screen. And okay, now we have the GLCC. The name of this fund is actually Global X Gold Producer Equity Covered Call ETF. It's a pretty long name. So basically, you can call it a gold miners covered call fund or covered call ETF. So what does it basically do? They pick gold mining stocks. So you can see the information on your left side of the screen. The reasons to consider GLCC. Basically, they provide direct exposure to some of the North American listed gold mining companies, and the fund looks to generate income through covered call writing. And when they do that covered call writing, they're able to generate that regular income. Yes, they're actually making a slight, sacrifice on the upside potential. So that's true for any covered call program. Yeah, of course, it's a monthly distribution of, income earned by the fund. They distribute to the investors. And you can see the price is around $50. Okay, last close is 54.50. Okay, the symbol is GLCC, the ticker symbol. And this fund was launched April 2011, but it's gone through a lot of changes in terms of the strategy and how the fund is operating. And you have all this information on the website. So I'm not going into that. This is listed on the Toronto Stock Exchange. The main thing we have to focus on is the management fee. Management fee is around 0.65, and the total management expense ratio is 0.77. And of course, you have all this information I will touch upon this um, portfolio metrics too. So overall, when you look at this fund, it is pretty decent. They're giving decent returns. Um, it's about 8 or 9% returns on distribution returns or distribution yield, which is not something so great. Like today, we hear about funds giving 30%, 40% returns uh, per year. So, so this is what we have. Let me show you the portfolio or the holdings. That's very important. This fund has about 37% of its holdings in Canada, roughly, and 35% is multinational, multiple nationalities. And you have 10% roughly US, 9% UK, and so on. So it's fairly diversified, well spread. And you can see the combination like GLDX, Barrick Mining Corporation, Newmont. So all these are big names in the precious metals space. Not only gold, but also they might be doing other things like silver and so on. You can see some of them have the name silver. But even the gold producers may be doing other things like copper, zinc, silver, which are also byproducts of that mining company. So keep that in mind. It's not just a gold fund. And this does not track the gold prices. This is the gold miners or gold producers fund. So that's something you need to keep at the back of your mind. So this is about the GLCC from Global X. Now let's look at the Hamilton fund, which is the AMAX. It's the Hamilton Gold Producer Yield Maximizer ETF. That's the name. Um, here they're saying it's a 10% yield, but it's slightly lesser. I will explain that later. Now, the fund is actually able to provide like higher monthly income, and again, this does not use any leverage or any special features. They provide exposure to the largest North American gold producers. This is exactly similar to the other fund we discussed. I will just show you the difference so that you can save time on this part. AMAX is the ticker, and yeah. So this fund basically has a flexible coverage ratio. Like they can decide how much coverage like to do. Usually it is around 50% for this fund. And the important feature to note down is you can see on the left side, income first. They do ATM calls. You can see on the left, income first. This maximize premium income with ATM call options. ATM means at the money, which means that the fund is writing calls close to the current market price, which means the fund has very little scope for appreciation. And what they do is they don't do this on the entire portfolio. So entire portfolio is not, capped for the upside. 50% of the portfolio will be capped in terms of the upside. So that's how it works like. So one half the portfolio is generating good returns income. The other half is actually capturing more upside from the appreciation of the gold producers. All these gold mining companies did well in the last year, I believe, like recent past. So because I'm saying based on the fund performance. Um, so individual companies may differ, but the fund has done well the last year. So yeah, they have been able to generate good amount of income plus capital appreciation. That's exactly what we are looking for, right? Being income investors, we need that flow of income plus also the appreciation. So those are the basic features of the fund. And let me show you the differences. But before that, let me show you how the funds have performed. Like when I just look at the price performance, let's say on Google like this, if I look at the price performance, I have the GLCC and AMAX here on the screen. I can expand it a little bit so you can see that. Uh, okay, you can see the chart where I'm comparing the GLCC, which is in blue, with AMAX, which is in the orange color, orange or amber. Now, if I look at the 1 month return, you can see it's almost close, like not that far, but you can see in the table below, GLCC made about 4.28%, AMAX minus 3.43, which means AMAX is slightly better. They were able to shield from the negative returns. So both of them underperformed in the 1 month. I mean, they delivered negative returns. That could be because of various reasons. Uh, Now let us look at the 6 months period. When I look at the 6 months period, GLCC is better off. because GLCC is giving you minus 4.65, AMAX is minus 6.14. So obviously GLCC is better of the two. If I look at the 1 year performance, going a little longer, now you can see the clear difference. The longer term performance is what we really care about. At least 1 year or 3 years. GLCC is giving you about 38.5% and AMAX 27 or close to 28%. Okay, are we missing the big picture here? Think about it. Am I missing something? Absolutely, yes, I'm missing something here. This is just the price performance. This is not including the distributions. So, along with the price, we need to add the distributions to get the full picture, get the exact apple to apple comparison. But this is just the price performance. But I'm just showing you this so you will know, like if you look at one parameter, you feel that GLCC is the best. But if you look at the other parameters, you might get a slightly different, you know, uh, number or different answer to your question, like which fund is performing well. Okay, let me move to the other comparison, which shows you the exact total returns, so that you know exactly whether you're getting the bang for the buck, as you know, the title of the video says. I go to the Seeking Alpha. I'm doing the same comparison. Now, here GLCC is in amber color and AMAX is in blue. You can clearly see from the picture 1 year, I put the 1 year mark. So if I expand it a bit so you can see clearly, you can see clearly that, GLCC is always on the top. The chart, you can see the orange line is on the top. GLCC is always, outperforming the AMAX. Let me go to three. Now you can see the numbers also. Like you can see around 43.96 and 32.58. This is over 1 year. Total returns. We have total returns here. So which means price plus the distribution. Let me expand this to 3 years. What do you see? Like overall, on the top, you see that GLCC is outperforming 145.5 and AMAX is close to 139%. Okay, so it's about 6% outperformance by GLCC. Now, let us give let us take a balanced view here. Like if you closely look at the chart, you can see there are some periods where the blue line is above the orange line. You can see 2024, most of 2024, like the fund GLCC was launched February 2024. Before that, they don't have the history. So, giving some benefit of doubt, like the fund is about 2 years old. Started February 2024. AMAX has been, beating the GLCC in 2024. Most of 2024, it has been beaten. So, which means that, uh, like each fund has certain strategies, and certain strategies perform well in certain market conditions, and certain other strategies perform well in other types of market conditions. So, worst case scenario, even if you pick the wrong fund, like you're not completely like losing money or did the wrong selection. Uh, that's one point I want to emphasize here. But always, it's always a good idea to know which fund is performing well, so you are putting your money into the right one. Um, yeah, in 2024, AMAX outperformed, but recently GLCC has been on top, and in the long run, GLCC has been delivering better returns. Now, the question now comes to our thought that how GLCC is able to beat AMAX. Are we missing something here, or is there something that makes GLCC kind of superior to AMAX? Okay, let me see the 1 month performance as well. Again, you can see that in 1 month maybe the AMAX is done well, but when you go for a longer period of time, GLCC is doing much better. Okay, the answer to that can be found if we do a much more dive deeper into the strategy of each of these funds. That's exactly what I've done here. And I mean, it's not to say that GLCC is better or AMAX is better, but I want to give you a unbiased view. I hold GLCC in one of my accounts. So obviously, I could be biased, but in this case, I'm completely taken out my personal view on these funds and just going by the numbers, going by the hard facts. So this video is not sponsored. It is not, to promote anything. Feel free to do your own research. But I want to show you the real picture now. Now, GLCC writes up to 50% in terms of covered call coverage. AMAX does approximately 50%. See the difference there. So basically, if you have a pie chart, like 50% of that, 50% of the portfolio, let's say portfolio is like a pie chart, and 50% of that is written as a covered call for the AMAX. But if you look at the GLCC, they don't do half their portfolio on right using covered call options. They can go like 20%, 30%, whatever level they want to play, they can do that. That's one of the key differences that makes Global X Fund superior. Because when you write lesser amount of covered calls, you can capture more price appreciation. However, there is a debate on that too. If the price appreciation is negative, like if the stocks don't go up, like if they go down, yeah, you get lower stock decline as well. Like so, more exposure to the appreciation, then you have the risk of depreciation or stock falling as well. But the thing is, these stocks do well over the long term. So if there is a way to capture that long term appreciation, GLCC would be a great way to go about that. But for someone who is looking at purely income, AMAX might be okay because they are writing covered calls at the market level, which means that they are not leaving much scope for appreciation on the covered part of the portfolio. Okay, keep that in mind. On the uncovered part of the portfolio, like AMAX 50%, which is not covered, they can go up according to the market levels. So AMAX gives something like a 50% roughly, ability to capture the upside fully, whereas GLCC says that uh, not going to cover like a big chunk. Like I may cover 30%, 40%, whatever, depending on the market level or depending on the fund manager's discretion. Let's say the GLCC is going only up to 30% in terms of covered calls. The remaining 70% of the portfolio can appreciate. Okay. So that's one part of the story, one big difference that makes a lot of difference in the returns. There is a second one which I'm going to touch upon now. I mean, this point is not that captured by many channels or many, you know, um, YouTubers, but they might have mentioned this, but they don't go deeper into this because some of the information or data is not readily available. Like you have to go dig into the fund details or documents or some of the fund fact sheets and data to find this. When I looked at the moneyness, moneyness means whether the fund writes at the money or out of the money calls. Like if you want to know about these terms, you can look into some of my previous videos. You will get an idea. But to give you a quick summary, at the money means writing calls at the current market price, whereas out of the money means you are writing calls higher than the current market price, which means the covered portion of the portfolio can also generate appreciation. Now, this is a little tricky, like little difficult to get around your head. Even for me, it was a little difficult. Even the covered part of the portfolio can have some appreciation. Usually, the normal logic is like hear about covered call funds. These funds will give you income, but they will cap your appreciation, or they will not give you appreciation. That was the normal concept of the idea that we have in mind, which is true in some cases. For some funds like GLCC, you have the covered calls, but the covered calls are not hurting the appreciation altogether. They are just writing out of the money calls, giving you that headroom for appreciation. So AMAX doesn't give you that headroom. GLCC is going to give you that headroom for appreciation. So yeah, now you get the sense like if you want that extra headroom appreciation in the covered part of the portfolio, GLCC is the good pick. Now that's why GLCC is able to get that extra. you know, punch or the extra bang for the buck. So appreciation is very high or potentially high for GLCC. Again, it all depends on the market conditions, how the stocks move. So nothing is set in stone. And again, in case of AMAX, it is moderate to high. And again, AMAX is not completely off the mark. Their design enables full appreciation only on 50% or half of the portfolio. So they are also doing good. They're going to give you moderate to high appreciation. Could get into the high zone, but it's more or less going to be in the moderate to high level. That these 2 points are the the key or the golden you know secrets that enable GLCC to give higher returns. Again, it doesn't mean the AMAX is bad. I also own AMAX indirectly, because I hold HDIV and HYLD. So in that one of those funds, AMAX is also included in the portfolio. So indirectly, I have some exposure to AMAX, but I have direct exposure to GLCC. So that's something I have to say here. Um, the fee point of view, like now you know the performance. Now let me look at the fee part of it. Regardless of how good the fee is, you are paying for performance ultimately because the total returns captures the performance. So let me quickly take you through the other aspects of these two funds that we have not discussed so far. Inception, we already covered that. The fee we covered it briefly. Like the fee is 0.65 for both funds, identical, and management expense ratio is also like identical. Not much to talk about here. If you look at the price and the yield, like that's where you see the difference. Like GLCC is $54.50 and this one is 34.72. I looked at the historical monthly distribution, like last 12 months. It is 4.64 for GLCC and 3.07 for AMAX. So when I did the math, like GLCC is about 8.5% and um, AMAX is about 8.8%. Not much of a difference in terms of the yield. So I don't think AMAX is paying too much in terms of yield or distribution, and that is not the reason that they are sacrificing on total returns. So I see that they are both like almost close to each other. So I will go back to the charts to see quickly, give you the summary. Like when you look at the 1 year performance, you see that GLCC is far ahead, like 43.96, 32.58. But let us go for a little shorter period to see the recent performance. And look at the 6 months. Again, GLCC is beating it. 4.62 minus and this is 6.46 minus. Of course, both of them are in the negative zone. If you look at like 1 month, just for example, if you look at 1 month. Now, in this case, you can see AMAX is minus 4.19, GLCC minus 4.64. So here AMAX is doing well. So, I mean, even if you pick the wrong one, you're not far behind. Like see in this case, AMAX is performing well. So this is how it works. Like when I expand it more to 3 years or longer period of time, I can see the returns are pretty good. Like even though AMAX is far behind, like at 139%, the difference is not much. Like when you look at the three-digit number, like 6% difference on this, it's not a big deal. Like, and this is over a period of 3 years. 138% over 3 years is it's extraordinary. Like, it's almost like you're doubling your money in 3 years. So I think the conclusion here is GLCC has a better edge because they're able to dynamically write the covered calls. Going back to the two key points that we discussed, because of the dynamism, GLCC is far superior. Whereas if you're looking at generating that regular income, you want the higher income, then AMAX could be a better choice. And if the market is not flat or down, like AMAX might outperform GLCC. And when the gold miners are doing well and it appreciates dramatically, GLCC might do well. So some people may look at it like this: I am going to put some in GLCC and some money in AMAX and get the best of both worlds. I think that's a great, brilliant strategy. Like I don't disagree with that. I would say that's a great idea. You are thinking on the right lines. Um, but I don't think you need to pick two or three gold funds and then two or three oil funds and two or three, you know, uranium funds. It's going to be too much of management for you. Like, even if you pick the incorrect one, you're not far behind. Both funds are performing well, and comparison shows that GLCC is beating AMAX. And I also like GLCC more because of the strategy, not because I like the fund or anything like that, or nothing, no sponsorship or no other relationship with any fund house or any product. So here, conclusion here is GLCC wins the race, and if you pick GLCC, yeah, very good luck, all the best. But if you picked AMAX, you are not far behind. You can still do well as long as you are sticking to your investment plan. So with that, happy investing. If you have any questions, any comments, please feel to drop them below. Have a great day. Thank you.